You know, usually when you look at a stock market ticker and it's just flashing red, there's this like immediate primal reaction.
Oh, absolutely. It's pure panic.
Right. It is literally designed to make you feel urgency. The numbers tick down, the red gets brighter, and the financial news chyrons start using these really heavy words like plummet or hemorrhage.
Yeah, it becomes a very binary thing in our heads, like green is safe and red means danger.
Exactly. But if you actually strip away the colors and look at the mathematical architecture underneath those movements, suddenly that straightforward narrative of danger gets, really complicated.
It does. It changes completely.
And that's what we're getting into today. Welcome to today's deep dive. Just to establish where we are, it is Wednesday, August 19th, 2026. And today we're doing something a little different for you.
Right. We're definitely not just reading the headlines today.
No, not at all. We have gathered a massive stack of technical analysis charts, market support zones, and raw data for the KSE-100 index.
Which is quite the stack.
It is. And our mission today is to decode what a surface level market drop actually means when you stop reacting to the red ink and actually start reading the technical indicators.
Because, frankly, the headline today is a big one.
It's massive. The KSE-100 index dropped over 1,100 points today. Literally, it closed at 176,846.36, dropping 11,109.14 points.
Right.
Which is a 0.62% drop on a volume of nearly 410 million shares. I mean, to anyone just glancing at their phone between meetings, seeing a 4-digit drop looks like an absolute disaster.
Oh, it certainly has that psychological shock value. I mean, 1,000 points just feels heavy.
Yeah.
But that's exactly why we need to step back.
Yeah.
Because a single day's drop, even a seemingly massive one like today's, is really just one pixel in a much larger, much more complex picture.
Okay, let's unpack this. Because like you said, a 1,000-point drop sounds terrifying to a casual observer. It sounds like falling off a cliff.
It does, but when we let the sheer size of the nominal number panic us, we completely lose sight of the proportional reality.
Right, the proportions. Let's look at those. Today's session had a high of 178,942.31 and a low of 176,638.10.
Right, and when you zoom out just a bit, the year-to-date change for the KSE-100 is actually still sitting in the green.
Wait, really? Even after today?
Yeah, it's actually up. It's up exactly 1.60%.
Wow. Okay, but the really wild number in our notes is the one-year change. The index is up a massive 18.08% over the last year.
Which is huge.
Right. We're looking at a 52-week range that stretches all the way from a floor of 144,119.44 up to a ceiling of 191,032.73.
Exactly.
So considering we're up 18% in a year, isn't an 1,100-point drop just, a minor pothole on a really long highway?
If we connect this to the bigger picture, your pothole analogy is exactly right. This is where the distinction between short-term daily volatility and long-term stability becomes so crucial.
So we shouldn't be panicking.
No, absolutely not. You have to remember, an index sitting at nearly 177,000 points is mathematically going to experience larger nominal swings.
Because the baseline is so high.
Exactly. 1,100-point move today is essentially just a fraction of a percent. Like you mentioned, it's exactly a 0.62% drop.
Right.
Imagine you were looking at a smaller index priced at just 1,000 points. A 0.62% drop on that index is just 6 points.
Oh, wow. Yeah, that wouldn't even make the evening news.
It wouldn't. The long-term trend, as evidenced by that 18% one-year gain, shows a market that has experienced significant, sustained growth.
So zooming out basically prevents us from falling victim to recency bias.
Right, that trap where we think today's red candle is the only thing that matters.
Yeah, the sky is falling.
Exactly. But that macro health check gives us the safety net to then zoom back in and ask, okay, if the overall highway is intact, what exactly caused the market to hit this specific pothole today?
Which brings us to the engine room of this whole thing. We're
Right.
looking at the 4-hour chart for the KSE-100. And for you listening, traders often use a 4-hour chart because it filters out the chaotic noise of every single minute, but it still moves faster and gives more immediate signals than a daily chart.
Yeah, it's a really great middle ground.
And right now, the 4-hour chart shows some serious bearish momentum in these recent sessions.
It does.
But here's where it gets really interesting. The data relies heavily on an indicator called the stochastic RSI. And in our notes, there's this string of numbers attached to it. 14, 14, 3, 3.
Right, the 14, 14, 3, 3.
It sounds like a locker combination. What exactly are we looking at here?
It does sound a bit cryptic. Let's demystify that, because it's crucial for understanding the market's mood right now.
Please do.
The stochastic RSI is simply a mathematical way of measuring momentum. The 14 14 represents the look-back period, usually 14 trading sessions.
Okay.
The formula is essentially asking, where is the current price compared to the highest and lowest prices over the last 14 periods?
Got it. And the threes?
The three at the end are just smoothing factors. They take the raw, jagged data and sort of iron out the erratic jumps so you get a clearer, smoother trend line.
So I like to think of it like a car. The actual price of the index is the physical location of the car on the road. But the stochastic RSI is the speedometer. It tells you how fast the car is moving in that direction.
That is a perfect way to look at it.
And right now, according to this data, the KSE-100 is categorized as deeply oversold. The values for the current momentum, the PSO, is at 1.6495, and the smoothed out average, the PSE, is 1.1715. They're scraping the absolute bottom of the barrel.
Yeah, they are extremely low.
Now, an RSI is on a scale of 0 to 100. So an RSI approaching 1, it's like wringing out a sponge until it's bone dry. There is literally not a single drop of water left.
Exactly. The technical term in the notes is selling pressure reaching exhaustion.
Right, but I have to push back a little here. Just because the sellers are exhausted and the sponge is bone dry, how do we know buyers will actually step in? I mean, couldn't the sponge just stay dry on the counter for a week?
That is the perfect question to ask, really, because it highlights a very common misunderstanding of how technical analysis actually works. Well, you're right. An oversold condition, even one as extreme as 1.6, does not guarantee an immediate, miraculous V-shaped spike back to the top. The sponge can indeed sit there dry for a bit.
Okay.
However, what this deeply oversold reading signals is a high probability event. It indicates that the downward velocity has mathematically run out of steam.
So the panic is just over.
Yes. The people who were panicked, or the short-term traders who wanted to sell, they've already sold. Therefore, the probability shifts heavily toward a technical bounce, or a period of consolidation.
Which just means the market moves sideways to catch its breath.
Exactly.
But what actually causes that bounce? Like, why does the math make people buy?
It comes down to the mechanics of institutional trade zones.
Okay, the big money.
Right. We're talking about the major players' pension funds, algorithmic trading desks, massive mutual funds. They do not buy when the market is falling fast. They don't try to catch a falling knife.
Yeah, that makes sense.
They wait for exactly these exhausted, oversold levels. They are watching these extreme lows because the risk-to-reward ratio suddenly flips heavily in their favor.
Oh, I see.
They look for specific support zones to re-enter the market, knowing that the selling pressure has essentially evaporated.
Okay, so the broad market is essentially wandering the desert, heavily oversold, completely exhausted, and primed for a potential bounce because the big money is just waiting in the wings.
Pretty much.
But an index is just an average of a bunch of different companies.
Yeah.
I want to see if this is true on the ground level. Let's look at the cement sector first.
Sure.
We have Lucky Cement, ticker LUCK. The stochastic RSI here is also deeply oversold, sitting right around 4.05.
Right.
And the data shows traders are eyeing a key support zone around 438.24 and a secondary one down at 422.28. And it has resistance at 449.89 and 456.94.
Yes.
But if we're trying to understand the how and the why, what does a support level of 438.24 actually mean in the real world? Is it just like a line drawn on a chart?
It often looks like a magical invisible line on a chart, but it's actually incredibly tangible.
Okay.
Think of a support zone as a historical price memory.
Historical price memory.
Yeah, at some point in the past, when Lucky Cement hit 438.24, a massive amount of buyers stepped in and said, this is bargain, and drove the price up.
Oh, okay.
Institutional algorithms remember that. So what happens is these major funds will pre-program massive buy orders, limit orders, right at that 438.24 level. They essentially park their money there.
So it's waiting for it to fall.
Exactly. As the price drops and approaches that number, it hits this massive wall of pre-programmed buying power. It acts like a safety net catching a falling object.
That paints a really clear picture.
So when you combine a bone-dry RSI of 4 with a parked wall of money at 438, it becomes a very high probability launch pad for a reversal.
Wow. And it's not just Lucky Cement. I'm looking at DGKC Cement, ticker DGKC. It's showing the exact same pattern.
Yeah, it's very consistent.
It's oversold with an RSI near 19.94. And its historical safety net, its support zone, is sitting right around 208.24 with resistance at 215.47.
Exactly.
But then I looked at the oil sector in our stack of notes, specifically Pakistan State Oil, or PSO.
PSO, yes.
The analysts shifted to a 1-hour chart for this one rather than the 4-hour, and the RSI reading is I had to double check this. It is 0.14.
Yes.
Not 1.4, 0.14. And the support zone they are watching starts around 374.41, going down to 359.56, with resistance at 379.85.
Right.
So what does this all mean? If the overall market at 1.6 is a bone-dry sponge, what in the world is 0.14 for PSO? Are traders literally just giving these shares away?
What's fascinating here is that it really does look like a fire sale on paper, doesn't it?
Yeah, it looks totally broken.
But this is where the speed of the market dictates our tools.
Yeah.
The shift to the 1-hour chart is important. The volatility in the energy sector right now is moving so rapidly that traders need a tighter, faster time frame to spot the exact moment the selling stops.
Oh, because the 4 hours too slow for that kind of plunge?
Exactly. And a 0.14 RSI is essentially a sign of complete algorithmic capitulation.
Algorithmic capitulation.
Yeah. It's not that human beings are actively logging in to give their shares away. It's that when short-term panic hits, automated trading algorithms take over.
Right.
They're programmed to aggressively sell off assets when certain momentum thresholds are broken. When all of those algorithms trigger at the exact same time, it creates a cascading effect that pushes the RSI down to a microscopic number like 0.14.
So the algorithms just dump everything blindly.
Exactly. But here is the critical part. That is exactly what the bigger, smarter institutional money is waiting for. They know that an RSI of 0.14 means the selling is purely mechanical and emotional. It's not fundamentally based on the value of Pakistan state oil.
Right. The company didn't suddenly become worthless overnight.
Precisely. So they watch that 374.41 support zone like a hawk. It acts as a tripwire. When the price hits that tripwire and the selling algorithms have completely exhausted themselves, it sends a massive signal to the institutional buyers that the asset is fundamentally mispriced relative to its true value.
And then they strike.
They swoop in, buy up the discounted shares, and the market reverses.
So the support zone is the floor, and the RSI tells you they've hit the floor so hard they literally don't have the energy to dig a basement.
That's a great way to put it.
And looking through the rest of the data, this exhaustion is literally everywhere. We move from the heavyweights to the diverse pack of the rest of the board, and you see the exact same story.
It's very widespread today.
Yeah. Take Gandhara Tire and Rubber, ticker GTYR. Deeply oversold. RSI around 7.47. It has a support floor weighting at roughly 32.47 with resistance around 38.52.
Right.
Then you have the corporate and property sectors. TPL Corp is deeply oversold with an RSI of 5.96 watching a support tripwire near 22.08. Its sister company, TPL Properties, is right there with it. RSI near 7.53, support around 15.04. It's like the entire market across almost every sector ran a marathon and completely collapsed at the finish line.
That is a very accurate assessment of the broad market conditions. It's systematic exhaustion.
But wait, in this stack of charts, there's one fascinating anomaly. The lone wolf.
Oh, yes.
While the entire market, from tires to cement to oil to properties, is completely exhausted and screaming oversold, Pakistan Telecommunication, ticker PTC, is completely bucking the trend.
It really is.
Its momentum status is listed as neutral to turning up. It's setting pretty at an RSI of 42.04, and its support floor is around 70.51, with resistance at 75.35.
Right.
Why is this one telecom stock completely ignoring the macro environment? How can PTC have a healthy RSI of 42 when everything around it is scraping zero?
This raises an extremely important question, and it's perhaps the most vital lesson about technical analysis that we can take away today. It's the concept of correlation versus independence.
Okay, correlation versus independence.
Yeah. You have to remember that the KSE-100 index tells you the aggregate mood of the crowd. It tells you the sentiment of the macro environment.
Right.
And right now, as we've established, the crowd is exhausted. But individual stocks are still individual companies. They can always act independently based on sector-specific news, isolated buyer interest, or just fundamental corporate developments that completely outweigh the broader market panic.
Oh, I see.
Defensive stocks, or stocks with specific positive catalysts, will often ignore the macro trend entirely.
So PTC is essentially the control group in our experiment here.
Precisely. By functioning normally, it proves that the rest of the market is in an extreme state.
Right, because 42 is normal.
Exactly. An RSI of 42 is healthy. It has room to move up or down without being stretched to an extreme limit. It is finding buyers at that 70.51 support level who are completely ignoring the weakness in the cement and oil sectors.
That makes total sense.
If it's pouring rain outside, the broader market is getting soaked. But PTC is holding an umbrella. It proves that it is just a rainstorm, not the end of the world. It shows us that the market infrastructure isn't broken. Rather, capital is simply rotating. Money is flowing out of the exhausted sectors and finding shelter in isolated pockets of strength, while the selling pressure in the vast majority of the market has reached an absolute mathematical limit.
Okay, well, let's synthesize this whole journey we've been on because we've covered a lot of ground today.
We definitely have.
We started with what looked like a terrifying, alarming headline. It's August 19th, 2026, and the KSE-100 index dropped over 1,100 points. It looks like a cliff.
Right.
But by zooming out, we saw it was really just a 0.6% dip in a year that is up 18%. It was just a pothole.
Exactly.
And then, by looking under the hood at the 4-hour charts and the stochastic RSI, we revealed that this drop isn't a free fall. It is a massive, mathematically measurable case of market exhaustion.
Complete exhaustion.
Almost every major stock across multiple sectors, with the notable defiant exception of PTC acting as our control group, is hitting rock-bottom RSI levels. We're talking single digits, sometimes fractions of a single digit in the case of PSO.
Right, 0.14.
Exactly. The short-term sellers are exhausted, the algorithmic momentum has hit a wall, and the stage is fundamentally set for a potential bounce as these stocks coast into their historical support zones, those, pre-programmed tripwires where the institutional buyers are waiting patiently with their safety nets.
Exactly. You have summarized the mechanics perfectly. And that synthesis actually brings me to a final thought, something that really goes beyond the parameters of a 14-3-3 momentum chart.
Oh, what's that?
When we look at technical analysis, we use very clinical detached terms. We say things like deeply oversold. We say selling pressure exhaustion.
Right. We make it sound like physics.
Exactly. We talk about support and resistance zones as if they are physical barriers made of concrete and steel. But for everyone listening, it's worth asking, are we really just looking at math? Or are these charts actually just EKGs of collective human psychology? Right. Behind every single one of those 410 million shares traded today is a human decision. Someone feeling fear or greed or panic or relief. When an index hits a stochastic RSI of 1, is it the numbers that have run out of momentum? Or is it simply that human beings have literally run out of the emotional energy required to keep panicking?
That is fascinating.
The math is just a reflection of us. It measures our collective anxiety. And historically, when the panic completely exhausts itself, that is usually when the clearest, most lucrative opportunities begin to emerge for those who are paying attention.
An EKG of collective human psychology. I absolutely love that. It takes these dry numbers and makes them deeply human. For you listening, thank you for joining us on this deep dive into the charts today.
Thanks for having me.
Of course, the next time you see a sea of red on your trading screen and a 1,000-point drop in the headlines, remember to look past the primal panic. Check the exhaustion levels, look for those historical support tripwires, and always keep looking beneath the surface. We'll catch you on the next one.